The hardest part is for business owners to take a pause and be willing to have that conversation. Most business owners haven't done a true price increase in a number of years. Well, I'm afraid that, I'll lose customers. You probably will, but you'll have more profitable customers. 9 times out of 10, people don't start just because they're afraid. And not because it's not a good idea, not because the timing's not right. It's because they're afraid of changing from the lifestyle that they're at right now to whatever may be next. I mean, I'm a risk taker myself, but there are certain things that we need to be smart about. If a spouse gets cancer, you're probably not going to think as clearly about it. So think about it when you're of a clear mind as opposed to because you have to.
This is the Relentless Pursuit of Winning podcast, where we are here to educate, equip, and inspire people to build extraordinary companies. We're so glad you're here. Don't forget to like, subscribe, and hit the bell so you can get updates every time we drop a new episode. Now, let's get it started. We are back with another episode of the Relentless Pursuit of Winning podcast. My name is Rick Meekins. I am your host as usual. And in the studio today, we have Zach Jennings. How are you today, sir?
I'm great, Rick. How are you?
I'm doing absolutely fantastic. Thank you for asking. Folks, if you haven't done it already, I would love it if you'd like, subscribe, hit the bell so you get updates every time we drop a new episode. And without further ado, let's get to it. So Zach, welcome to the show. And as usual, what we're going to do, what we'll start off is tell us a little bit about yourself, who you are, what you do, and why you do what you do.
Yeah. So I am an entrepreneur through and through. It's in my family. So my grandfather had many businesses, dad had many businesses, and other family members had many businesses. I went out on my own probably close to 10 years ago. I started out with a large consulting company. I was consulting for large organizations. I also have built a marine accessory product. It's a product that I wanted on my boat. So I got a patent, saw an opportunity in the marketplace and took it to market and sell it online now. And then recently, as of last year, I started Southern Exits, which is an exit advisory firm. And so we help small business owners prepare to exit and to grow the value of the enterprise before they're need to exit.
Oh man, awesome. So entrepreneurship is in your family. Is that something like when you were younger, you were just like, hey, I want to do this thing? Or what made you take your particular journey, going to college, I guess, and then going into the big firm and then, branching out?
Yeah, it was something I was always one that was talking about different business models, different business ideas, even as a young kid. And then I remember even my roommate in college, we would stay up late and hypothesize about different business ventures that we were going to start and all that. And so it's always been something that I don't know that I've always said hey, I'm going to be an entrepreneur as much as it just was always in my mind of, well, we could do this, I could do that. And I finally got to a point where instead of wait for somebody else to do that idea I had, I said, well, I'm just going to be that somebody and go out there and do it. You figure out a lot as you go, you learn a lot as you go. And years later, you have a lot of experience and now you can start to apply those lessons.
What was your first venture? What was that thing that you said, hey, you know what, I'm just gonna do the thing?
Yeah, there was a number of kind of small side hustle businesses that kind of took place along the way. The kind of the first one that was successful was the consulting practice, and I knew I wanted to go out on my own, but I saw a quick niche and a quick opportunity, honestly, in the market for myself. I wanted to go out probably 5 years later. I wanted a little bit more time in industry, and then I saw the market opportunity that was now, and so instead of just waiting, I took it and opened the practice and grew it over a number of years. So had a lot of fun with it.
Wow. What were some things that you did jumping off that you may have done differently, with in hindsight?
Yeah, I think and this goes to a lot to what I do now, right? Is to set things up the right way and grow it smart. I definitely would have looked at a lot of different options for expanding contracts. I would have looked at scaling a little bit sooner, honestly. I was always kind of hesitant because I had some key accounts that were absolute cash cows. And for those, you just kind of reap the benefits of them. But if you don't keep maintain a good balance of things, then sometimes you those cash cows, they dry up sometimes, right?
Yeah, I certainly do. Certainly do. One thing that is going through my mind is that idea of the entrepreneur's mindset. You
Mm.
know, I talk to people that have never started companies, and oh, I'm afraid to do the thing, and there's a space, there's a type of thinking I think that really enables entrepreneurs to really go forward. What do you make of that?
Yeah, I definitely think there is. And I remember, when I first started, there was always there's a an imposter in the back of your head, if you're honest, right? There's a fear of failure with it. There's a million reasons you could line up of why it couldn't. But if you look at those reasons, you get to control all those 9 times out of 10, right? It's your attitude, it's your willingness to pivot, it's your willingness to keep going at that. And I love it when people that are not, haven't started a business come to me and say, "Hey, Zach, I got this business idea. What do you think about it?" I will almost never tell them, don't do something with that. I'll give them some feedback on it, but I think that 9 times out of 10, people don't start just because they're afraid. Not because it's not a good idea, not because the timing's not right, not any of that. It's because they're afraid of where they're at. They're afraid of changing from the lifestyle that maybe they're at right now
Yeah,
to whatever may be next, and they're afraid that that would be a step back for them. It's the same thing I think for business owners for exiting is that they're afraid is one of the reasons they don't actually engage into it until much further down the road is because they're afraid the lifestyle they have right now is not going to be the lifestyle and their identity is going to be totally different and they don't know what that looks like and they haven't had the ability to think through it.
that's interesting. You know what? I've had 7 or 8 businesses, and I don't think I've ever. While I'm a strong advocate, for systems and processes and that sort of thing, and building a company that can scale. But I've never really thought in terms of building a company in order to sell.
Hmm.
And part of that was because I know that in a lot of the cases, I was the kind of the brains behind it. I brought my unique capabilities to the business. What do you say to someone like me that that's in that particular situation?
Yeah, I deal with that a lot of times, and sometimes they've got a small staff around them. Sometimes I actually was talking to somebody this week. It's a solo company, and they've got a book of business, right? So they've got operations, they've got systems, they've got that book of business, but in their mind, 9 times out of 10, it's a non-transferable asset, which is not the case always, right? With some planning and some changes and some work you can take that asset that maybe you built up to a couple $1,000,000 worth of enterprise value and you can start to shift it. Now, the way you're set up right now, where you close the door, it's just you, right? That is not transferable. If you maintain all the relationships and all that, that's not transferable. But there's things that you can still do even as yourself, especially if you get kind of really strategic about how you structure some kind of a deal to bring in an operator is one thing that we were talking about with this other one, but making sure that they're set up for success long term and make sure the terms are where they need to be. So I think a lot of times, especially on the more main street side of businesses, that size, that's it's maybe that they're doing maybe 1 million or less. Those are actually the ones that when they get ready to quote unquote retire, it's turn the lights out. It's not even a consideration. And I think it's a big mistake because they've worked really hard to actually build something that could be one of the greatest assets they actually have. And I think it's just a shame that they don't even think about it. They just, will move on to the next page.
Yeah, yeah, yeah. I see that a lot. I see that a lot. I see folks that I've got a friend that he built a boiler company, and he built the company around himself.
Hmm.
So he's the tech, he's the sales guy. He's got a staff of like 5 or 10 people, and it's like you have the conversation. It's like there's potential there. You
Yep.
don't have to sell the company just for the assets, just for what you have in the warehouse and your customer base, but you have the opportunity. You have a transferable asset,
Yeah.
and
Yeah.
so it's a conversation that I think he was willing to have, but just wasn't quite there. What do you how do you broach that conversation? I mean, you see a business, you walk into an organization, you're like, dude, you've got a gold mine here,
Right.
but they don't quite
Yeah.
see it. What does that conversation look like?
Yeah. So a lot of times where we like to start is people have, especially owners, have various opinions about what they're worth or not worth. And so we like to start with doing a business valuation just to say, hey, this is what your business is worth right now. This is what best in class looks like. Best in class are things that make it more transferable. You have contracts and reoccurring revenues. You have systems in place. You have things that will keep the business going and keep the cash flow going, despite you being there, in the business. So we look at that and say, hey, here's where you're at. Here's what best in class is. We actually build an application that helps us walk through this. It does an assessment, and it really does a end-to-end view of the business. And what I love about it is it asks additional questions based off of those responses. It asks smarter questions that dive down into, hey, this looks like a weak place. Let's dive into it and ask more questions around that. To be able to bring to life, hey, here's the areas that you are really, really strong at. Here's the areas that we really need to improve. I think that the hardest part, honestly, is just for business owners to take a pause and be willing to have that conversation. Because a lot of times, like I said earlier, it's an uncomfortable thing for them. Even though ultimately what I'm trying to get to is I'm trying to see them win. That's one of my goals, is to see small business owners win.
The winner. That's a winner. You used the term valuation.
Mhm.
And you talked about a number of things behind that. I need to unpack that a little bit more. Because it seems like one of those terms that people, it's like, hey, I want $4 million for your business. What's the basis for that? You know,
Yeah,
what is the
yeah.
business actually worth? What is it? Can we actually get for the business? Talk to me about that, and perhaps how that valuation can be increased to maybe get to,
Yeah.
for this case in point, that $4 million number.
Yeah. So for most businesses, they use what's called EBITDA, earnings before income taxes, depreciation, and assets, or they'll use SDE, which is seller discretionary earnings. Ultimately, we're trying to see how much cash flows, how much cash the business can spin off of. Each of those have multiples, so you have an EBITDA multiple, and you'll get a range with that. Same thing, you could do it with SDs. SDs are usually for kind of smaller size businesses. Once you get above 1 million or so is when we start looking at EBITDA a little bit more often. But the way that we really try and focus on increasing the value is there's a couple different areas with it. One is to increase that cash flow. So how much cash flow can we get? How can we increase the EBITDA over time? And there's a number of ways that we can do that. That could be, increase the overall profitability. There's a number of different kind of levers that we have to be able to do that. I personally think that most businesses could stand to shed about 20% and add that to their bottom line, which, if I come in and do that, I think it's a win just in that. But the other area that we start to focus on is increasing your multiple. Now, what's going to command you to get a higher multiple is your transferability, and your ability to own a certain market. So there's a lot of different areas with that. I'm trying to keep it as high level as I can. But what we do is we go in and we'll work to increase that transferability, like I said, which is one way you can demand a higher multiple. The other piece is to start to position you for maybe a more strategic buyer that's willing to pay a higher premium, because what they're trying to do is secure a certain territory, a certain market or something like that. So that's another area that we can kind of go in strategically, make those changes. Ultimately, all this is going back to increasing the enterprise value. So there's really, you've got the cash flow, and then you have your multiple, which is really what you're looking at. Where we get those multiples from is recent business sales. So I like to correlate in a lot of times to house sales. Have your purchase price, but then you have your price per square foot kind of piece. That's kind of like that EBITDA piece of it. Of, hey, there's this many square feet. That's how much cash flow we have, right? So now, what is that price per square foot? Multiply those two together, and that'll give us our purchase price on thing.
I've heard people say that their business is worth its revenue, like one year revenue, whatever that looks like. Is that an accurate statement?
No, so uh, there are some industries that use that. Smaller ones are going to be using a little bit more of that. The way I really do valuations and look into that is if you're just looking at top line, there is so much under the hood that you've not assessed, right? There's so much there. I mean, you could have a company doing $5 billion in revenue that's not profitable at all. Like nobody wants to buy that. So that's really not worth 1 year's worth of revenue. So I would say the least confident, the least defendable valuation is going to be on top line. And then once you start to kind of, you know, get down into the weeds and all is a better way to do it. So I think it's really important to look at what the industry is doing. So we'll take that NAICS code or that, a business that's similar to whichever client we're dealing with and say over the past, couple of years, this is what has been selling and this is what it's been selling like. This is the high end of it. This is low end, but just to kind of blindly take 1 years of revenue, I don't think really paints an accurate picture. So it's kind of going back to the housing piece. It's well, my neighbor sold for this amount. That means I should probably get that. It's like not really. It's a different house. It's a different business doing different things.
Yeah, that makes sense. That makes sense. So, what about the idea of valuation based on like multiple years of, based on future performance? How does that play? So, you mentioned like, looking at where the industry is headed, for
Hmm.
example. And, we have a company that, is at a certain level. However, we expect the industry to increase, 5%, 10%, whatever that is over a year. How does that get calculated into the overall selling price?
Yeah, so it's a consideration. There's kind of a couple things with that. One is the contracts that we have locked in right now, will they continue 2, 3 years down the road? Or will they come to end of life and, in 6 months, 12 months or something like that? If that's the case, we will have that as a consideration and it'll be a discount when we do the valuation. In terms of where the market is heading, you really would have to prove it out because the future of things is really it's a prediction and a lot of times buyers that unless it's a strong prediction that they have and you have a lot of proof,
Hmm.
they're not going to just kind of take your faith. Oh, I think that the market's going to really adjust to here. But I think I'm trying to think of some good examples. If you have started a business that's a kind of a new niche that's starting to take off and you see it in a local market that is taking off and then you go to an adjacent market and that takes off as well. That's a good indicator of future growth that somebody will pay a higher price for. And that would be kind of into that. So but a lot of times we like to really take it based off of the historical performance. I usually like to have at least 3 years of statements on that. What I do then is then once we have our overall assessment, we'll actually project out 5 years, what revenue will look like, what EBITDA will look like, what we think we can grow, you know, within that range, your multiple two, based off of changing certain aspects of your business.
Mm, mm. Makes sense. I see one of the other things I see, especially with smaller companies, is where we've got a consistent customer base and we have the founder that's going to be leaving the organization at some point. How do you calculate in attrition in your valuation, or how does that work?
Yeah, so exits are an interesting thing because anytime an owner is getting ready to exit, it's you want it to be the most confidential thing because when people, especially an owner or a key employee is getting ready to leave, I think people all of a sudden assume the worst, and that is that everybody else is going to leave, which is not always the case. I think a better place to be instead of having a complete keeping everybody completely in the dark is put a plan in play, communicate that plan ahead of time, right? Have conversations, put any kind of things that you need to in place, maybe to keep certain key personnel around. I it will play a factor to the valuation, especially. I mean, if you've got an owner and then their number two person, but when the owner leaves, that number two person is going to leave, and that's really where all the domain knowledge is tied up in an organization. That is going to be a major discount for you. That's honestly just almost just as bad as the owner itself. Just the dependencies there they can be with the owner.
Interesting. How important is And maybe it's a dumb question, but I mean, I think about technology. I was working with a company years ago that was doing. They were basically making equipment, an engineering company that was making equipment for like the power lines and that sort of thing. And I mean, they were literally using green screens and dot matrix printers. It was 15 years ago, but still, I wonder. I mean, they're doing numbers. I mean, they're really great at what they're doing. They're delivering on time. They've got a great customer base. They're not going to, it's a recession proof business essentially. How does their technology, how does their tech stack play into the overall value of the company?
Yeah, it plays a huge aspect to it. They're going to be discounted because it's not necessarily a discount as much as they could be a whole lot more profitable if they would
Yeah.
invest in, and upgrade technologies. It'd be an initial investment. That's one of the things that we go in and look at is to say, hey, if we were able to upgrade to this and this, our profitability may look like this. That would put your valuation in the future at this piece. Here's your initial investment for it. So it's going to play a huge role into it. But also, I think an interesting aspect of it is a buyer is going to spell that out real quick and they're going to look at it, try to discount it because they know the fix. And that's what they're going to do. They're going to buy it, put that technology in, or make the upgrades that they know that they need to, and then they're going to be sitting on a whole lot more equity.
So, I mean, do you guide them like on the cost effectiveness of that? Because I mean, if you think about the idea, that company in particular, they would need, $100,000 in technology upgrades. They'd have to trade their staff. We're going to have those folks that know everything that say, you know what, I'm not doing it like this, and they're leaving the
Yeah.
company. I mean, it's a whole thing.
Yeah.
Do you work through like a cost benefit analysis with that?
Yes. Yeah. We'll work through a cost benefit analysis depending on what it is we're implementing. I may pull in somebody else that has more expertise in that area. I have found that in this space there are some advisors that like to think that they know everything. I think everybody should run away from those because anybody that thinks that they know everything probably doesn't know that much, honestly.
Lipstick on
But
pig.
that's right, lipstick on a pig, man. But I really like to I know where I'm really good at, and that's assessing the business. That's the operations of it. That's doing kind of the analysis to see what is that benefit. I can also pull together the strategy around things, put the entire plan together for you.
Yeah.
But if it comes down to actually how do we implement this, what does that typically look like in an organization and all that? It's the technology I'm not familiar with. Why would I act like I actually know that? But to get back to your question of do I walk them through that? Absolutely. I think that it for me the worst thing I could do is say, oh, what you need to do because the spreadsheet said so is make this change. I fully get that there are human interactions here, right? There's emotions and all that are taking place. And they're thinking about the human side of it, not just the dollar side of it. Walk through that with them. Part of what we also do is talk about kind of your personal plan, right? So this the work I do is not just spreadsheets, just numbers and saying, hey, this is what you need to do. It's thinking about it holistically, because I think that there's what do you want to do, what are you willing to do, and then what do you actually do. And those could be different things.
What does it typically take? So we talked about, doing that assessment. We talked about creating a strategy, ideally and I'm assuming that's is that to get to exit at a certain, purchasing price?
Yeah, it could be purchased. So that's part of it. Some of the first questions we ask is like, what are the goals around this? I've had people that say by X date, I want to be totally out. I've had people that say, I want to slowly transition out. I've had people say, I need X dollars. I'll partner from part of it is I partner with their financial planner to say, what is your wealth goal that you actually need? So can you sell this business right now and meet the goal that you have. Maybe, maybe not. That could be something that we feed into the model of what we need to do. So it's really based off of their goal. Do they want to do an internal transfer, an external transfer? The thing I love about exits is the deal structuring of it. And the options are endless almost. They're almost endless. And that's what I want to create is that optionality for an owner based off of what their goals are. So We'll go in, do that assessment, and understand what are your goals. We'll put a strategy in place. We'll align the team that you'll need because you're going to need, a whole team to do this kind of work. And then we'll walk with you every step of the way.
What do you do? I guess you talked about internal transfer. What does that look like? What I'm thinking about is, as a founder, you build the company to a certain point, and you're like, hey, you know what? At a certain point, I want to exit the company, and I want the company to be run by my child or my children or something like that. However, I need them to have some oversight, or whatever
Yeah.
that looks like. How do you work with companies in that type of situation, or is that advisable even?
I want to do what the owner wants to do. I think sometimes I was talking to somebody else about this a couple of weeks ago. They were talking about transfer to children. That was always the exit plan for the owner, the parents, but they never had a conversation with the children about it. Right. So we go in and have a conversation. Hey, Joe, just make it up a name, right? Do you actually want to take over this business? No, that's the last thing I want to do. Well, we probably should come up with a different plan. Like they don't want the business, right? So I do think that internal transfers or family transfers, they absolutely can work. What we're seeing is first to second generation, you have a pretty good percentage chance. There's
Mhm.
actually a huge drop. I would say down to maybe 3% to go down to third generation. So again, it's based off what your goals are. There was some I was talking to that they were charitably inclined, right? And so there's a way that you can set up a trust that you put proceeds over into a trust, right? And you have to give it to that trust once all that goes in all. Like there's so many different ways you can do it. So
Interesting. I think one of the I guess where I want to go now is thinking in terms of, really getting a good footing. You start your
mm,
company. In my mind, you get proof of concept, after, whatever time frame. At what point do you say, hey, you know what, I need to start thinking about, or it would be smart to start thinking about exiting that company? And
yeah,
and I'm gonna throw a caveat in there. You love doing what you do, so it could be
yeah,
consulting, like your company.
yeah.
At what point do you say, "Hey, you know what? I need to be thinking about a longer term play."
One of the things I love about how I kind of operate with business owners is we operate on a retainer basis, right? And so we meet with them monthly, sometimes multiple times a month, depending on kind of the engagement level we have. But every 90 days, we're focusing on some initiative that we're trying to change. But at the end of that 90 days, the first question we ask is, do you want to continue growing or do you want to sell it? Right? So to answer your question of when should you come in, uh, I, I typically work with businesses that you most of the time they're doing about 2 million in revenue. Some of them I'll take on a little bit less than that if they've got some good opportunities, and I've done some valuations for some a little bit less than that. Uh, the reason is just for it to make sense for an engagement level. Also, I think below, I would even say 500,000, you're probably still figuring out a lot of systems, right? And you know this as a systems person yourself. Like if you scale bad systems, it's really bad. It's bad. It gets bad exponentially. So when we come in, we really I think it makes the most sense somewhere between the ideal time I would say would be 5, maybe 7 years. That's a long play, right? Uh, I would probably do more of a lighter touch engagement with that, and we're just building the business along the way, but we're building it to sell. We always know, and we're making decisions based off of that at play, as opposed to let's restructure to sell. Those are different strategies. One is built along the way. Other one is maybe deleting things that we've bad habits or things that we've done. I'm not sure if I fully answered your.
You did, you did, you did. So what occurs to me next is, so at that point, you come in at that 5, that 7-year mark, and we've got a pipeline of 10 years. It's like I'm not retiring until I'm, 65
Yeah.
or whatever that, or 70 or whatever that looks like. Do you come in as a coach initially and then move into more of a consultant later on, or how does that work? And what is the difference between those
Yeah.
two levels of engagement?
So it's a similar role that I'm playing. I think where my role shifts the most is on the front and on the end. And I say on the front because that is very, very much a hey, here's a snapshot. Here's what you got. Here's a plan.
Yeah.
You can implement it if you want to. If you want help implementing that, then that's when I kind of come in and wear, the advisor, the consulting, coaching hat. They're all different. I don't wear them at the same time. But then at the end is pulling a team together and being when you get ready to sell a business, there's a lot of things that take place. It's a lot of paperwork, it's a lot of coordination, it's a lot of things that need to take place. And so that's where it's a bit of a different role that I would play there. I wouldn't really sit in the broker space as much as helping walk the owner through that state, which is just different than restructuring a business.
What sorts of things do you put into place, or what kind of framework or process or whatever do you have to make sure that company is able to last that, that 10 or 15 years while you're working with them?
Yeah. So, to be fair, I think the 10 years and all that, like that's the ideal state. Most owners aren't going to do that. Most owners aren't going to have a conversation outside of 3 to 5 years, right? It's ideal because you just have the most time, the most ability to make change, and probably the most willingness, I would say, in some ways. But the things that we're putting in play is I think it's very, very important to not just say, hey, in the future, your company's going to be worth X. I think it's important for them to feel that now, for them to feel it's easier to do business now, for them to see the profitability increase now, for them to see physically the growth now. That goes back to making it easier to operate a business so that you can put the strategy in place of how to scale it. And then you can get to some of those transferability pieces, but you got to build the steps along the way.
So dig into that a little bit for me.
Yeah. So on the operate kind of side of the house, that is, hey, what are the key KPIs that we need to be measuring? What is it that it actually tells us we're good, we're not good for the month? We need to have a dashboard of that. We need to see that, and then we need to have a plan in play of when this goes this way or that way, what is the steps that we do? What are the actions we do? What are the levers we pull? How do we actually get it back on track? What else do we need to pivot to or change to? It's a leading indicator as opposed to a lagging indicator for us. Is what we want to be looking at is making sure that we're there. So that's one area. The other area, I am a huge fan of SOPs, but I think SOPs in a electronic or a physical copy that are not actually implemented are pretty much worthless, right? Like if it's not part of the culture of the people, it's not that valuable. I think it's more valuable walking through what does the process look like and getting alignment on that than it is like we documented X, Y, and Z. So that's another area is that we now have a standard way that we can operate this. The other area I think that most often business owners, especially if you've been in business for a number of years, they're afraid to pull this lever, and that's increasing prices. We've seen historical cost increases over the last 6 years, but in terms of what business owners are charging, small business owners specifically, they're absorbing a lot of those as opposed to actually passing those costs on. Most business owners haven't done a true price increase in a number of years. Well, Rick, I'm afraid that, I'll lose customers. You probably will, but you'll have more profitable customers. We've got to do that smart. We got to do it intelligently because ultimately we want to get to where if you could service, instead of servicing, 1,000 customers, you could service 500 customers for the same profitability. Why would you not? Right.
Yeah. Yeah, that makes total sense. You have your 5 Ds where you talk about the difference between companies that survive and those that collapse. Dig into that a little bit more too.
Yeah. So the 5 Ds, it's death, disability, divorce, distress, and disagreement. Even just saying that, I imagine that you and the listeners know a number of people, business owners or not, that have dealt with that. I mean, especially that disagreement piece, right?
Yeah.
That one comes up a whole lot more than you would actually expect. But there is a 50% chance, I think it's 50% chance that a business owner will sell their business or close their business because of one of those. 50% chance, right? So, I mean, just you and I, there's a 50%, like one of us is going to have that happen to us. Just sit here, right?
Yeah.
And so I think that it's really unfortunate that business owners, I mean, I'm a risk taker myself, but there are certain things that we need to be smart about. And that is looking at statistics and saying, this is likely to happen. So let's put some plans in play. And that could be having an exit plan, right? Just of saying, hey, this is what I want, or structuring it so you have that optionality if something like that happens. If all of a sudden there is some kind of death or disease or divorce or something that comes, you've got a plan in play already. Because the worst time actually for you to be working on that plan is in the middle of chaos, right? In the middle of a divorce or some kind of, if somebody like a spouse or something like that gets cancer, that is the worst time. And you probably don't even want to think about that during that time, and you're probably not going to think as clearly about it during that time. So think about it when you're of good, clear mind, as opposed to because you have to.
Yeah. You brought up planning a number of times. We talked about KPIs, you talked about strategy, we talked about, future planning and all of that good stuff. And maybe I'm curious, what I'm just thinking about how much time, and how much effort and, even for a business owner, how much outside of the box thinking that requires, for a founder, for an owner to be able to really execute on that and do it really, really well. And I'm thinking, longer term from the perspective of, creating that wealth. Hey, at the
Hmm.
end of, when I sell my business, I want to be able to, XYZ. I want to be able to reinvest, whatever that's going to look like. How do you guide someone through the thinking around that? Because again, I mean, you've got to be able to pin them down, so to speak, and we need real answers. We don't need, off the cuff, hey, I want to buy a boat and a house in South Carolina,
Yeah,
right?
yeah, yep. Yeah, the first answer I usually get is the wild one, and usually I like to call it the avoidance answer, which is fine. It's okay to get that out there to start with. One of the things that we do is we'll put it on paper, and I like to get them to kind of imagine, an average Wednesday or some day of the week. Like, if you weren't here, what would you want to be doing? So I start to get them to kind of dream about things, and those things that they're dreaming about there is probably somewhere where they would like to be doing, right? So we start to have those kind of conversations. We'll put up, the initial draft out on paper because I think it's important for them to see that. Uh, and then after that, I always like to pressure test it, right? With a spouse, with somebody that a close mentor of theirs, maybe a good friend of theirs or something like that. I think it's really important to have others' perspectives on it because a lot of times with these personal kind of pieces like this, other people can say, I could always see Rick doing X, Y, and Z down the road. Right. And if the answer is absolutely, that makes sense. I see it. Then, okay, it's probably a decent plan. But if they come back and say, not a chance, like, what is this plan? But sometimes it takes a number of conversations to get there. I fully recognize that business owners are very 9 times out of 10, they're very matter of fact, very straight to business. What is it I got to do to get there? They don't want to talk about the squishy, fluffy, kind of emotional stuff. And I'm happy to engage that, along the way. But ultimately, we got to get to where you're not exiting from something, but you're exiting to something.
Wow, I love that. I love that. We need that needs to be a soundbite.
Perfect.
Excellent, excellent, excellent. So, big question. So, if I am watching the show, listening to the show, how does this conversation about exiting my business, how does that need to start?
Yeah. Yeah, so we start with what we call an exit clarity call, which is really just a no pressure, no obligation. It's a conversation about where you're at and what is it that you want, right? Just an initial, 30-minute conversation. We talk through our process, how we do the assessment, how we do evaluation, how we put the plan together. We talk through all those kind of pieces, but it's just a way for you to fully understand and be able to see what our process looks like and how we can help you out with that. I would strongly encourage any business owner, even if you aren't working with me, go find an exit strategist or an exit advisor and have a conversation with them. One, you're probably going to learn something about either yourself or your business that can help improve things. But two, if you're not engaging with one, you're probably leaving money on the table and you're not optimizing in the way that you ultimately could. Yes, yes. I think that, it's important for all business owners to have that. So I absolutely have multiple of them, actually.
So you're drinking the Kool-Aid. I love it.
I learned a long time ago if, I've got to kind of eat my own dog food on these things, right? And I get it. A lot of times the feedback you get from an advisor or a mentor or a business coach, it's frustrating because it puts you in that tension of it's the thing that I know I need to do that I don't want to do, right? That's the tension that they are willing to hold you to, or it's the clarity sometimes that they can provide of have you considered?
I like it. I like it. All right, last question for you.
Yeah, man.
So the name of the show is the Relentless Pursuit of Winning podcast. Anybody can define winning in whatever way they want to. The hard part, though, of course, is that relentless pursuit. How would you advise someone to maintain that relentless pursuit towards their goal?
Yeah, um, I think for all entrepreneurs, they relentlessly go after things. And I tell people all the time, dream big, but start small and keep pushing and keep pushing. I can't tell you how many times I've failed, how many times I've pivoted, but don't give up.
Hmm. I agree.
That's the part of it, right? It's the path.
No, absolutely. Zach, if somebody wants to reach out to you, wants to connect with you, what are the best ways to do that?
Yep. So you can check out our website, southernexits.com. Also follow us on LinkedIn. We're on LinkedIn, Facebook, YouTube. We put a number of content out, especially on LinkedIn. Follow us there. We've got a lot of assessments and different tools. And we have a Try This series, which is taken off pretty good of just different things that business owners can try in their business to help improve it.
Awesome. Awesome. We'll definitely get those on your show notes. Zach, thank you so much for being on the show. Enjoyed our conversation.
Absolutely. Thanks, Rick. I have really enjoyed it.
Awesome. Awesome. And folks, thank you so much for watching or listening to another episode of the Relentless Pursuit of Winning podcast. We'll catch you next time.